Imagine waking up tomorrow morning and checking the news. Unemployment just hit 6%. Your neighbor lost his job last week. Your cousin got laid off the month before. The job market is falling apart. But here's the weird thing, prices are still going up. You go to the grocery store and everything costs more than it did last month. Gas, more expensive. Rent, higher. Your paycheck? If you still have one, it's buying less and less every single week. You think to yourself, okay, this is bad, but the government will fix it, right? They'll lower interest rates, stimulate the economy, get people back to work. But they can't, because if they lower rates and pump money into the economy, inflation gets worse. And if they raise rates to fight inflation, more people lose their jobs. The government is paralyzed. They can't fix one problem without making the other one worse. This isn't some dystopian future I'm making up. This is exactly what happened to the United States in the 1970s. It's called stagflation, and it's considered the worst case scenario in economics. High unemployment, high inflation, economic stagnation, all at the same time. And right now, in October 2025, some of the smartest economists in the world are warning that we might be headed toward it again. So here's what we need to figure out. What is stagflation? How bad can it actually get? And more importantly, how close are we really to experiencing it again? Hey, I'm Brandon, and welcome back to My Money Mint, the channel where I dive into topics related to money and wealth. All right, let's get into it. Let's start with the basics. What actually is stagflation? The word itself is a combination of stagnation and inflation, and it describes something that economists used to think was impossible. Here's why. For most of the 20th century, economists believed in something called the Phillips curve. The idea was simple. There's a trade-off between unemployment and inflation. When unemployment is low, inflation tends to be high because everyone has jobs and is spending money, driving up prices. When unemployment is high, inflation tends to be low because nobody's spending money, so prices stay stable or even fall. This made sense. It fit the data. And it meant that policymakers had a clear playbook. Economy overheating with too much inflation? Raise interest rates to cool things down. Unemployment goes up a bit, but inflation comes down. Economy in recession with high unemployment? Lower interest rates to stimulate growth? Inflation might tick up, but people get jobs. Then the 1970s happened, and everything economists thought they knew got destroyed. Because suddenly, the United States was experiencing high unemployment and high inflation at the same time. The Phillips curve was broken. The playbook didn't work anymore, and policymakers were completely lost. Stagflation is the simultaneous occurrence of three terrible things: high inflation, where prices are rising rapidly, high unemployment, where people are losing jobs, and stagnant or negative economic growth, meaning the economy is either not growing or actively shrinking. It's like getting punched in the face from three different directions at once. And there's no simple way to defend yourself. Here's what makes it so devastating. The tools you use to fix one problem make the other problems worse. If the Federal Reserve lowers interest rates to help unemployed people get jobs, they pour more money into the economy, which makes inflation worse. If they raise interest rates to fight inflation, borrowing becomes more expensive, businesses cut jobs, and unemployment gets worse. You're stuck between a rock and a hard place, choosing which crisis you want to make worse. So let's talk about what happened in the 1970s. Because if you want to understand how bad stagflation can get, you need to understand this decade. The 1970s were brutal. There were actually two distinct episodes of stagflation, and both of them were triggered by the same thing: oil. The first episode started in 1973 with the OPEC oil embargo. OPEC, the Organization of Petroleum Exporting Countries, decided to stop selling oil to the United States and other Western countries that supported Israel during the Yom Kippur War. Almost overnight, oil prices quadrupled. Think about what that means. Suddenly, everything that requires oil to produce or transport, which is basically everything, became way more expensive. Inflation, which had been running at a relatively manageable 3 to 4% in the late 1960s, exploded to 11.1% by 1974. At the same time, businesses were getting crushed by higher energy costs, so they started laying people off. Unemployment peaked at 9% in May 1975. The economy contracted from November 1973 to March 1975, a recession that lasted about 16 months. People were suffering. You had workers losing their jobs while the cost of everything was skyrocketing. And the government? They tried wage and price controls under Nixon, literally telling businesses they couldn't raise prices above certain levels. It didn't work. It just created shortages and made things worse. Then, just when things were starting to stabilize in the late 1970s, it happened again. In 1979, the Iranian Revolution disrupted oil production in the Middle East, and oil prices tripled again. This time, it was even worse. Inflation peaked at 13.5% in 1980. Unemployment reached 10.8% in November and December of 1982. The economy went through two recessions, one in 1980 and another from 1982 to 1983, 1981 to 1982. This was a double-dip recession, meaning the economy started to recover and then collapsed again. Let me put this in perspective. 13.5% inflation means that if something cost $100 at the start of the year, it cost $113.5 by the end of the year. Your savings were being destroyed. And at the same time, 1 in 10 Americans who wanted a job couldn't find one. There was something called a wage price spiral happening. Workers demanded higher wages to keep up with inflation, and businesses passed those higher labor costs on to consumers through higher prices, which made workers demand even higher wages. It was a vicious cycle that seemed impossible to break. The Federal Reserve kept making things worse by flip-flopping. They'd raise rates to fight inflation, the economy would start to tank, they'd get scared and lower rates, inflation would come roaring back and they'd have to raise rates again. They lost all credibility. People stopped believing the Fed could or would control inflation, and when people stop believing that, inflation becomes a self-fulfilling prophecy. If everyone expects prices to go up, they act in ways that make prices go up. Then, in August 1979, a man named Paul Volcker became chairman of the Federal Reserve. And he did something that was considered absolutely insane at the time. He raised interest rates to levels never seen before or since in American history. By January 1981, the federal funds rate, the rate banks charge each other for overnight loans, hit 20.06%. 20%. Think about what that means. If you wanted to borrow money to buy a house, mortgage rates were in the high teens. If you were a business trying to expand, loans were so expensive that it made no sense to borrow. The entire economy seized up. Volcker's strategy was simple but brutal. He was going to kill inflation no matter what. He didn't care about unemployment. He didn't care about the political pressure. He was going to keep rates high until inflation was dead. And it worked, but at an enormous cost. Unemployment hit 10.8%. Businesses went bankrupt. Families lost their homes. There were protests outside the Federal Reserve. Construction workers sent Volcker pieces of lumber with notes saying they couldn't find work. But inflation fell from 13.5% to under 5% by the end of 1982. Volcker had broken the back of inflation. And, in the process, he established the credibility that the Federal Reserve has maintained ever since. He proved that the Fed would do whatever it takes to control inflation. The lesson from the 1970s is clear. Stagflation is absolutely devastating to ordinary people, and the cure is almost as painful as the disease itself. So now, let's talk about 2025. Are we headed toward another 1970s-style disaster? Let's look at the data. And I'm going to give you both sides of this argument because smart people disagree about how worried we should be. First, let's talk about inflation. As of August 2025, the Consumer Price Index, the measure of how much prices are rising, came in at 2.9% year over year. That's up slightly from 2.7% in July. Core CPI, which excludes food and energy because they're volatile, is at 3.1%. Now, here's the context you need. Back in June 2022, inflation peaked at 9.1%. So we've made massive progress. We're down more than 6 percentage points from the peak. The Federal Reserve's target is 2%, so we're not that far off. But here's the problem: inflation has been sticky. It's been really hard to get that last percentage point down, and certain categories are still rising pretty fast. Food prices are up 0.5% just in August alone, with fruits and vegetables up 1.6%. Housing and shelter costs, which are the biggest component of most people's budgets, remain elevated. Services inflation is more persistent than goods inflation, and the Fed's preferred measure, something called the PCE, personal consumption expenditures, is running at about 2.74%, with core PCE around 2.6% to 2.9%. So inflation is better than it was, but it's not quite at target yet, and the worry is that it might have stopped declining. Now let's talk about unemployment. As of August 2025, the unemployment rate is 4.3%. That's up slightly from 4.2% in July. Now, on its face, 4.3% unemployment is actually really good historically. During the 2008 financial crisis, unemployment hit 10%. During the COVID pandemic, it briefly hit almost 15%. So 4.3% is pretty low. But here's what has economists worried: it's the direction. Unemployment has been rising. It was down at 3.4% at its lowest point, and more importantly, the quality of the job market is deteriorating. In August 2025, the economy only added 22,000 jobs. That's terrible. In July, it added 73,000, and that number was revised down by 258,000 from previous estimates. That last part is huge. It means the job market was much weaker than we thought it was. These revisions are telling us that the economy has been creating far fewer jobs than the initial reports suggested. And job growth is now concentrated in just three sectors: healthcare, construction, and leisure and hospitality. Everything else is either flat or losing jobs. There are other warning signs too. The number of discouraged workers, people who want a job but have given up looking, is at 514,000. The hires rate, which measures how many people are getting new jobs, is declining, and historically, when the hires rate falls, recessions tend to follow. Layoffs are still low at about 1.0% to 1.1%, which is good, but the fact that companies aren't hiring is concerning. So we have unemployment that's low by historical standards but rising, and we have inflation that's way better than it was but still above target. That combination is starting to look a little bit like the early stages of stagflation. Now let's talk about economic growth. In 2024, the US economy grew at 2.8% for the full year. That's pretty solid. But 2025 has been weird. In the first quarter of 2025, GDP contracted by 0.5% to 0.6%. That's negative growth, a technical recession if it had lasted 2 quarters. Now, there's some debate about how much of that contraction was real versus technical. A lot of it was because businesses imported a massive amount of goods ahead of expected tariffs, and imports subtract from GDP in the way it's calculated. So it might not have been as bad as it looked. But then, in the second quarter, GDP rebounded with 3.8% annualized growth. Sounds great, right? Except when you dig into the numbers, underlying domestic demand only grew at 1.2%. So the headline number looked strong, but the real economy was weaker. As of October 7th, the Atlanta Fed's GDP Now model, which tracks the economy in real time, is estimating Q3 growth at 3.8% as well. So growth is positive, but volatile and uncertain. Economists have been downgrading their forecasts pretty significantly. Early in the year, people were expecting around 2.4% growth for 2025. Now the consensus is more like 1.4% to 1.9%. That's a big downgrade. For 2026, projections range from 1.4% to 2.1%, depending heavily on what happens with trade policy. So we're not in a recession, but we're not exactly booming either. The economy is kind of limping along. Now here's one piece of good news: real wages. Real wages are wages adjusted for inflation, so they tell you whether your paycheck is actually buying you more stuff or less stuff. From July 2024 to July 2025, nominal wages, your actual paycheck, grew by 4.2%. Inflation was 2.7%. That means real wages grew by 1.5%. Your purchasing power is increasing. Weekly earnings increased by $18 in real terms. This is really important because from 2021 to 2023, real wages were negative for 25 consecutive months. People were getting poorer even if they got raises because inflation was eating away at everything. But since February 2024, wages have consistently outpaced inflation. That's a big deal. However, here's the catch. Overall, since January 2021, real wages are still down by about 0.7% to 1.2%, depending on which measure you use. So we're recovering, but we haven't fully made up for the losses during the high inflation period. A lot of people still feel behind because they are behind compared to where they were a few years ago. All right, so let's talk about the Federal Reserve and what they're doing about all this. As of October 2025, the federal funds rate is at 4.00% to 4.25%. In September, the Fed cut rates by 0.25%, the first rate cut of the year. Before that, they had held rates steady at 4.25% to 4.50% for 5 consecutive meetings from January to July. The peak rate was 5.25% to 5.50% back in 2023. So the Fed is now in cutting mode. They're lowering rates to try to support the economy. The expectation is that they'll cut rates 2 more times in 2025, probably at the October and December meetings, bringing rates down to about 3.50% to 3.75% by year end. And they're expected to cut more in 2026, reaching around 3.25% to 3.50% by mid year. But here's the challenge the Fed is facing. They're trying to walk a very fine line. If they cut rates too early or too much, they risk reigniting inflation, which is still above their 2% target. If they cut too late or too little, they risk causing an unnecessary recession by keeping borrowing costs too high for too long. Fed Chair Jerome Powell has said the Fed is in no hurry to cut rates. They're being cautious, watching the data carefully, trying to make the right call. And there's a complicating factor: tariffs. The Trump administration has imposed significant tariffs on imports, particularly from China. These tariffs are creating what economists call a stagflationary pressure. On one hand, tariffs raise the cost of imported goods, which pushes UP inflation. On the other hand, tariffs act like a tax on consumers. They have less money to spend on other things, which slows down the economy and can lead to job losses. So tariffs make both problems worse at the same time. That's why they're so dangerous in the current environment. Let me give you some numbers. The current average statutory tariff rate is around 18.6%. That's way higher than it was just a few years ago. Some deals have been made that reduce certain tariffs, but overall, trade policy uncertainty is very high. And when businesses don't know what trade policy is going to be, they freeze up. They don't invest. They don't hire. They wait to see what happens. Now, let's talk about the differences between now and the 1970s, because this is crucial to understanding whether we're really heading towards stagflation. The 1970s had a specific set of circumstances that made stagflation so bad, and many of those circumstances are different today. First, energy independence. In the 1970s, the United States was heavily dependent on imported oil from OPEC. When OPEC cut off the supply, the US was screwed. There was no alternative. Today, the United States is a net energy exporter. We produce more oil and natural gas than we consume. If there's a disruption in the Middle East, it's not great, but we're not as vulnerable as we were in the 1970s. This is a huge difference. Second, monetary policy framework. In the 1970s, the Fed didn't have a clear inflation target. They were reactive, not proactive. They made mistakes, lost credibility, and let inflation get out of control. Today, the Fed has an explicit 2% inflation target. They have better tools. They communicate more clearly about what they're going to do, and they have the credibility that Paul Volcker earned for them in the 1980s. People generally believe the Fed will control inflation, and that belief is powerful. Third, labor market flexibility. In the 1970s, labor unions were much stronger and many workers had contracts that automatically increased their wages when inflation went up. This created a wage price spiral that was really hard to break. Today, unions are much weaker, for better or worse, and labor markets are more flexible. Wages don't automatically rise with inflation in most industries. This makes it easier to break an inflationary cycle. Fourth, globalization. Despite recent talk about deglobalization and reshoring, the US economy is still much more integrated into global supply chains than it was in the 1970s. This means we can import goods from all over the world, which provides some cost relief. If prices go up too much in one place, we can source from somewhere else. In the 1970s, the economy was much less globalized. Fifth, technology and productivity. There's a lot of excitement and maybe hype about artificial intelligence and how it might boost productivity. If AI actually delivers on its promise, it could allow the economy to grow faster without causing inflation because we're producing more with the same resources. In the 1970s, there was actually a productivity slowdown, which made everything worse. So these are real meaningful differences. But, and this is a big but, there are also some worrying similarities and new risks that we didn't have in the 1970s. Let's talk about the arguments for why we might be heading towards stagflation. First, inflation is proving sticky. It's been really hard to get core inflation below 3%. Housing costs, which are a huge part of the inflation calculation, are slow to come down. Services inflation is persistent. And every month that inflation stays above the Fed's target, there's a risk that people start expecting it to stay high, and expectations can become self-fulfilling. Second, the labor market is clearly weakening. That 22,000 jobs number in August was terrible. The revisions showing the job market was weaker than we thought are concerning. The hires rate is falling, and while unemployment is still low, it's rising. If this trend continues, we could see unemployment at 5% or even higher by the end of 2025. Third, economic growth is slowing. Those downgraded forecasts from 2.4% to 1.4 to 1.9% are significant. Business investment is weakening outside of AI and tech. Consumer confidence is declining sharply. Manufacturing is in contraction according to the ISM indices. The economy is losing momentum. Fourth, tariffs are creating exactly the kind of supply shock that causes stagflation. They're raising costs for businesses, which gets passed on to consumers as higher prices. But they're also reducing consumer purchasing power and creating uncertainty that freezes business investment. It's a double whammy. And fifth, policy uncertainty. Businesses don't know what trade policy will be next month or next year. They don't know what regulations will look like. They don't know what tax policy will be. So they're not investing. They're not hiring. They're waiting. And when everyone waits, the economy stagnates. Several prominent economists are sounding the alarm. Michael Feroli from JP Morgan predicts unemployment rising to 5.3% with core inflation at 4.4% in 2025. That would be clear stagflation territory. Torsten Slok from Apollo projects GDP at just 1.2% with inflation near 3% and rising unemployment. Olu Sonola from Fitch says, the risk of stagflation has risen meaningfully. Greg Dako, the chief economist at EY, says the odds of stagflation are uncomfortably high. Even Fed Chair Jerome Powell, while carefully avoiding the word stagflation, has cautioned that tariffs could raise both unemployment and inflation at the same time. That's literally the definition of stagflation, even if he won't say the word. Some analysts are putting the probability of a recession in 2025 at 40% to 45%. And if that recession comes with inflation still above 3%, that's stagflation. But now let's talk about the other side. The arguments for why we're not heading towards stagflation and why we're going to be okay. First, inflation has come down dramatically. Going from 9.1% to 2.9% is huge progress. We're not that far from the Fed's 2% target. Goods prices are actually deflating in many categories. Supply chains have normalized from the pandemic chaos, and inflation expectations, as measured by various surveys, remain relatively anchored. People still generally believe the Fed will get inflation under control. Second, economic growth is still positive. That 3.8% GDP growth in Q2 and Q3, even if driven partly by technical factors, is still growth. Consumer spending remains resilient. The AI investment boom is supporting significant business spending. Corporate profits are generally solid. The stock market is near all-time highs, which suggests investors are optimistic about the future. Third, the labor market, while weakening, is still historically strong. 4.3% unemployment is low by any historical measure. Layoffs remain rare. Companies are reluctant to shed workers. There are still multiple job openings available in most sectors. Real wages are finally growing, which gives consumers purchasing power. We're not seeing mass layoffs like you'd expect at the start of a real recession. And fourth, we're not in the 1970s. The energy independence, the Fed's credibility, the flexible labor markets, the technology advantages, these all matter. The shocks we're facing today are different. Tariffs are a policy choice, not an external catastrophe like the OPEC embargo. Policy choices can be reversed. If stagflation really starts to develop, the government could negotiate trade deals, reduce tariffs, and eliminate a lot of the pressure. You couldn't negotiate with OPEC in the 1970s to bring oil prices down. Economists, like those at Goldman Sachs, put the recession probability at only 15%. They see a soft landing, where the economy slows down just enough to bring inflation to target without causing a recession. Jack Kleinhans, the chief economist at the National Retail Federation, says the economy is on the cusp of nailing the soft landing. Bill Adams from Comerica notes that tariffs are a one-time shock to prices, not a sustained driver of ongoing inflation. Once prices adjust to the new tariff levels, inflation should moderate. And Treasury Secretary Janet Yellen has expressed confidence that we can avoid the worst outcomes. So, what's the actual answer? What's most likely to happen? The consensus among economists is that we're facing what some are calling stagflation light, or a growth recession. A situation where growth is weak and inflation is elevated, but we don't hit the extreme levels of the 1970s. The probability of severe 1970s style stagflation is estimated at around 10% to 15%. It's not the most likely outcome. The most likely scenario, with about 40% to 50% probability, is a soft landing, where the economy slows down, inflation gradually comes down to 2% by 2026, unemployment peaks around 4.5% to 4.6%, and the Fed successfully manages the descent with gradual rate cuts. The second most likely scenario, at about 30% to 35% probability, is a mild recession. 1 or 2 quarters of negative growth, unemployment rising to around 5%, but then inflation moderates naturally, the Fed cuts rates aggressively, and we recover by 2026. This wouldn't be fun, but it wouldn't be catastrophic either. Stagflation, where we have prolonged negative growth, unemployment above 5.5%, and inflation staying at or above 3% for multiple quarters, is only about 10% to 15% likely. It's possible, but not probable. There's even a 10% to 15% chance that we get strong continued growth, where GDP exceeds 2.5%, the labor market re-strengthens, inflation falls quickly to target, and the Fed cuts rates less than expected because the economy doesn't need as much support. So, what should you be watching? What are the key indicators that will tell us which scenario we're actually in? On the labor market side, watch the unemployment rate. If it rises above 4.5%, recession risk increases sharply. Watch weekly jobless claims. If they're consistently above 250,000, that's concerning. Watch the JOLTS report on job openings. Continued declines signal weakening demand for workers. Watch the hires rate. If it keeps falling, that historically precedes recessions. And watch the layoff rate. If it rises above 1.3%, that signals a turning point. On the inflation side, watch core PCE. It needs to decline toward 2% for the all clear. Watch wage growth. If it reaccelerates above 4.5%, inflation might stay sticky. Watch rent and housing inflation, since that's the largest component. And watch inflation expectations in surveys. If people start expecting higher inflation, it can become self-fulfilling. On the growth side, watch the Atlanta Fed's GDP Now tracker for real-time economic estimates. Watch consumer spending, which is the biggest component of GDP. Watch the ISM manufacturing and services indices. Below 50 means contraction. And watch business investment, particularly outside the AI and tech sector. On the financial side, watch credit spreads. If they widen significantly, it indicates rising recession risk. Watch stock market volatility. Sustained high VIX levels suggests serious uncertainty. And watch consumer credit delinquencies. If they're rising, it indicates financial stress. And watch policy. Tariff changes, Fed communications, and trade negotiations will all tell you a lot about which direction we're heading. So here's the bottom line. As of October 2025, the United States is not experiencing true stagflation. We're experiencing some concerning trends: weakening job growth, sticky inflation, slowing GDP, but we're not in a crisis. The probability of severe 1970s style stagflation is low, around 10% to 15%, because we have better tools, better policy frameworks, and key structural advantages like energy independence. The most likely outcome is that the Fed manages to engineer a soft landing or, at worst, a mild recession. But risks are elevated above normal. Tariff policies are creating real stagflationary pressures. The labor market is weakening faster than expected. Policy uncertainty is high. The next 3 to 6 months of economic data will be critical in determining whether we pull off the soft landing or slip into something worse. If you're worried about your personal finances, here's what you should do. Maintain a solid emergency fund of 6 to 12 months of expenses. If you have variable rate debt, consider refinancing to fixed rates while you still can. If you're employed, negotiate raises aggressively to keep pace with inflation. Diversify your investments. Don't be all in on growth stocks if stagflation is a real risk. Consider some inflation hedges like Treasury inflation protected securities or commodities. But don't panic. The US economy has faced challenges before and come through them. We have advantages that we didn't have in the 1970s, and policymakers are aware of the risks and are actively trying to avoid the worst outcomes. Stagflation is the worst case scenario, but it's not the most likely scenario. Stay informed, stay prepared, and keep watching those key indicators. Thank you for watching My Money Mint. If this breakdown helped you understand what's really going on with the economy, hit that subscribe button and drop a comment below. Are you worried about stagflation, or do you think we're going to pull off the soft landing? Let me know your thoughts, and I'll see you in the next one.